Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guests today are Nicole Hunter, Head of Capital Markets, and Wes Krill, Head of Investment Strategies at Dimensional Fund Advisors. Dimensional Fund Advisors, or DFA, is a pioneering asset manager known mainly for its smart beta strategies. They were actually among the first companies to apply academic research to practical investing. And they currently have about $660 billion in assets under management. DFA assets were only available to large institutional investors and through financial advisors that were vetted by them earlier. In fact, for decades, retail investors couldn't directly buy DFA funds. Last month, DFA converted 4 of its tax-managed mutual funds into ETFs and became one of the top 15 ETF issuers overnight. They now offer 7 ETFs, and with these ETFs, any retail investors can access DFA's strategies, their investing strategies, without an advisor. So with DFA, we'll talk about these conversions and their future ETF plans, and we will also talk about their mid-year outlook and how investors should position their portfolios for the remainder of 2021. Joining me now are Nicole Hunter and Wes Krill. Nicole and Wes, welcome to both of you. Great to have you on the show.
Yeah, thanks for having us.
Yeah, thanks for having us, Nina.
To start off, please tell us a little bit about DFA and DFA's investing approach, which is very unique.
Yeah, I'd be happy to. Of course, Dimensional was founded in 1981, and for 4 decades now, we've had an investment approach that was really built around implementing the great ideas in finance. And as part of this, we've always had a very deep connection to the academic community with such luminaries as Eugene Fama, Ken French, Robert Merton, Robert Novi Marx, and I would say central to our investment philosophy is a belief in markets. We seek to outperform the market, not by trying to outguess market prices, but to systematically pursue sources of higher expected returns that have been uncovered by decades of rigorous academic evidence. And we do so just with a fanatic attention to the role of implementation. And we do this in a very systematic way. You can almost think of it as taking the best bits of passive investing, so broad diversification, low expense ratios, low turnover, but adding an active approach that helps a continuous focus on these higher expected returns and then managing risk through a flexible daily process.
Very interesting. Now, I wanted to talk about conversion of your mutual funds into ETFs. And last month, DFA converted 4 of its tax-managed mutual funds with about $30 billion in assets into ETFs. And these are U.S. equity ETF, ticker symbol DFUS, U.S. core equity 2 ETF, ticker symbol DFAC, then U.S. small cap ETF, ticker symbol DFAS, and U.S. targeted value ETF, ticker symbol DFAT. So tell us about this conversion, why these ETFs were selected for why these mutual funds were selected for conversion, why and now?
This is actually a really exciting time for Dimensional. Having recently joined Dimensional and coming with a background in ETFs, I was really excited to partner with a firm that's so innovative. As Wes talked about, the systematic approach, the blending the best of index and the flexibility and of active, and with a 40-year track record, it's a really exciting time. And when we were thinking about what we've been hearing from clients for so long, they wanted the ETF wrapper, it fit into their business, and we were looking at, should we have new ETFs that we bring to market? Should we convert? What's going to be the best fit? There's a combination of both. And you saw late last year, we launched 3 standalone core equity ETFs, DFAU, DFAI, DFAE. But then we converted, as you mentioned, these 4 mutual funds into ETFs, a $30 billion switch. And it came on the back of, again, client demand, really looking for greater tax efficiency through the ETF wrapper. And so we heard that loud and clear. And, after the passage of the ETF rule, we knew we could deliver our approach, right? Our systematic approach in an ETF wrapper. And it really allowed us to open up the door for new funds and converted funds. These converted funds in particular, tax managed strategies, right? So investors that already were looking for, they're tax sensitive and they wanted to make sure that they had the best tools available for that sensitivity. And ETFs, as you know, offer a unique tax efficiency process through their in-kind redemptions. And so they were a good fit. And clients were really excited and were on board to make this conversion happen. I will tell you, I've been very impressed that just all the hard work that goes into a conversion of this size. I mean, sure, we weren't the first, but we were the biggest. And there's a lot of details. And so we took our time. We made sure that our communication at some points was maybe more than necessary, but we figured over communicating was better. And we spent, not me in particular, but there are a lot of amazing people at Dimensional who worked through the weekends, long hours to make sure our clients had a seamless experience so that when they come into work and their mutual fund shares were now ETF shares, that was seamless. And that was true on my desk as well when I saw the ETF start quoting and trading that following morning after conversion. So from our perspective, the conversion in and of itself was successful and delivering what we always said we would do. And we'll take our time, we'll do it right, even if it's hard. And that's true in these conversions and along with other things that we do at Dimensional.
Very interesting and very exciting too. Investors definitely love ETFs because of their tax efficiency, their cost efficiency, and transparency. Now, I also wanted to talk about DFA's mid-year outlook. And before that, I was interested in your thoughts on inflation, because inflation is one of the biggest concerns for investors this year. And in fact, some of the recent inflation-related reports have been harder than expected. But the Federal Reserve says that this spike in inflation is transitory. It is driven mainly by factors related to the pandemic. And that is true to a great extent because supply chains around the world, they remain strained still. But still, it remains to be seen whether this spike in inflation is transitory or we are witnessing a historic shift after decades of low inflation. So I was interested in your thoughts on inflationary expectations and whether those concerns, inflation-related concerns, are overblown.
Well, it's a topic that's absolutely attracting a lot of attention. And, to your point, people are trying to assess whether they think it's going to be something that's more persistent or whether it is just a transitory spike in inflation. I think it's useful to first start with just the basics around inflation to distinguish between two types, which is expected inflation and unexpected inflation. So, as the name suggests, expected inflation is what market participants in aggregate expect. And one thing that's interesting about expected inflation is that we can see indicators in the market that are fueled by transactions of market participants that can help us gauge what the market's aggregate expectations are for inflation. For example, we can use break-even inflation. So we can look at the difference in yields between inflation-protected, say, 5-year treasuries and nominal treasuries of the same maturity. And those differences in yields tell you in part about how high or low the expectations are for inflation. And, as recently as last month, when we looked at the 5-year break-even inflation rates, they were hovering around 2.4%, which would imply on average about 2.4% inflation per year over that 5-year period. And if we look back at recent history, that's not particularly high. So what that tells me is that over the next 5 years, and even when we look at indicators over the 5 years after that, we don't see exceptionally high expectations for inflation as of now. Now, all that being said, some investors who are particularly sensitive to inflation might want to hedge against unexpected inflation. And there are definitely tools to do that. I mentioned inflation-protected securities. So that implies buying Treasury inflation-protected securities, which adjust the principal of those bonds in response to changes in consumer prices. So that's one way an investor can mitigate the impact of unexpected inflation. And then, there's other ways you can do that. You can have inflation swaps that are overlaid with non-treasury type bond portfolios for investors who are seeking higher expected returns and still want that inflation protection. But one thing investors should really take heart in is that expectations for inflation are already reflected in current market prices. That means the extent to which assets in your portfolio are sensitive to inflation, those expected levels of inflation are already being compensated in the prices that you're paying for those securities. So, again, distinguishing between those two types and seeing that the expected inflation part is not particularly high, and knowing that you're generally being compensated for that in your investment portfolio already, I think is one helpful thing for investors to keep in mind.
That's helpful. Now, Dimensional has been associated with value and small cap investing. So I wanted to talk about value and small cap investing as well. And we are seeing this sort of tug of war between value versus growth right now. Late last year and earlier this year, we saw value outperforming growth significantly and small caps outperforming large caps. But over the past few weeks, we have seen this resurgence in growth and resurgence in large caps, particularly mega cap tech stocks. A lot of investors are piling back into those mega cap tech stocks that was so popular during the pandemic last year. So do you expect value or growth? And between small caps and large caps, which area do you expect to outperform for the rest of this year? How should investors position their portfolios for the rest of 2021?
Yeah, it's probably interesting for investors to see the news about value, in different contexts. As recently as a year ago, people were talking about just this long stretch of underperformance for value and wondering what the future held for it. And then we had this remarkable turnaround, one of the best 6-month periods we've ever seen for small value versus large growth in the US, where that return difference of 62 percentage points was close to unprecedented. And then, of course, that brings about the same questions of, well, what's next? Is this it for the run, or can value continue to deliver the returns? I think it's worth going back to first principles. And when we talk about the premise behind value investing, it simply equates to paying less for a stream of future cash flows. So what that implies is value investing is about identifying high discount rate stocks. That means higher expected returns, and that is an evergreen principle. That's true no matter what's going on in the market, no matter what's happening with the economic climate. Paying less for future cash flows is always a higher expected return proposition, which means on expectations, we expect value stocks to have a higher return than growth stocks over any period. Now, we know that realized returns are a different story. Realized returns are going to be a function both of that expected return, but also unexpected. If we go back to Q1 of 2020, you saw the unexpected component cutting against value because you had the pandemic setting in, you had business closures due to the economic landscape. Large cap growth companies were in many ways more well poised to persevere through that economic shutdown than, say, small value companies. And so you saw outperformance from those companies that, again, was largely driven by unexpected occurrences. So we know realized returns can differ from expected returns. And we also know there's uncertainty around any premium or pursuing the market, whether it's just equities versus bills. We know that that's not been a sure thing, even over 10-year periods. Value versus growth, about 85% of 10-year periods in the US have been positive for value versus growth stocks. But that still implies that there is uncertainty even over longer time horizons. So, again, we believe that value should outperform growth. That is, in our opinion, one of the more reliable drivers of outperformance. If an investor is looking to outperform the market, that is a much higher proposition than trying to outguess markets. But there is uncertainty around it. And so we're never sure, even over a very long time horizon, that value will always outperform growth.
Very interesting. And since you mentioned value stocks, with value stocks, investors pay less for future cash flows. I wanted to talk a little bit about GameStop and AMC, which were which are kind of the poster children of this year's meme stock mania or Reddit frenzy. Now, these two stocks were part of the Russell 2000 Value Index, although these are neither small cap stocks nor value stocks after the insane surge that these stocks saw earlier this year. And now GameStop is out of Russell 2000 index. Now it is a part of FTSE Russell 1000 indexed after the reconstitution in June. But AMC is still a part of Russell 2000, Russell 2000 value. AMC has a market cap exceeding $20 billion. It's definitely not a value stock. But due to the timing of FTSE Russell's cutoff for data, which is used for reconstitution, that was May 7th. And at that time, AMC had a market capitalization of about $4.3 billion. So talk to us about your thoughts on these stocks being in the value and small cap indexes.
Yeah, you're exactly right about the AMC inclusion still in the Russell 2000 value. That size discrepancy at this point is veering towards if Yao Ming were to go and visit a kindergarten class for the day and how out of place he would look. But I think you point to a couple of mechanics that have to do with the way index or indices are constructed and rebalanced. That arbitrary date based around the sorting for eligibility, and just the fact that the Russell indices in particular are only being reconstituted once per year, during which the constituents of the index are changed. New securities are added, some will go out. And the fact that that's only happening once per year can lead to this phenomenon called style drift. And you can think of it as if you were to skip lawn mowing duties for a few months, what the state of your yard would be like. That's kind of what you see when you're only rebalancing once per year. Well, market prices are changing throughout the year. And so you might have companies that were fitting the definition of a small cap value company as of the last reconstitution, say 11, 12 months ago, but they might have risen up in price or in valuation ratio, might not be the definition anymore. On the other side of the coin, you might also have companies that have fallen down in price or in valuation ratio, and now they would fit the definition of a small cap value company. But because if that happens before the next reconstitution, they might not be included in a small cap index. And so for that reason, we believe in rebalancing our portfolios incrementally throughout the year. And what we do is we take a similar level of turnover as what an index might experience, but we want to do that on a daily basis. So reacting to how prices and valuation ratios and profitability characteristics are changing throughout the year. And what we believe that gets us is a more consistent focus on these sources of expected returns that we're trying to target. If you're trying to target a value premium, we want to have a consistent focus on value stocks. And one way that you might mitigate or lose some of your exposure to value companies is if you are having style drift. And so we think that's one really important determination. When I mentioned earlier about how we're trying to improve upon the already strong recipe of a passive type of solution and have active management with a daily approach. Well, that's one good reason why, is we want to keep that focus on higher expected returns to deliver more reliable outcomes for our investors.
So index and index tech tracking funds, many of them are subject to these quirks that sometimes hit markets out of nowhere. And it was a crazy year for the markets. So this wasn't even the craziest things that we saw. Now, I wanted to talk a little bit about your future ETF plans. There was a note by Bloomberg after your conversion. It said that more than $1 trillion worth of mutual fund assets could be converted into ETFs in the coming decade. And there was another note, prediction by Citigroup, that the $21 trillion mutual fund industry could consist mostly of ETFs within the next decade. So talking about DFA and your conversion plan, I know you are planning to convert 2 more mutual funds in the fall. And do you plan to convert all of your mutual funds to the ETF wrapper in the coming years?
I really appreciate this question. It's something we're getting a lot of, especially with the success of the 4 that we converted this summer. Because of course those offer that greater tax efficiency and ETF wrapper. We reduced management fees. We believe the ETF has reduced transaction costs. And of course, it was a tax-free event. We do look at our lineup, but again, we want to meet clients where they want to be. And we're really clear that the 4 funds that we converted, plus the 2 that will come later this fall, the international equity ones, those were for clients that were in tax managed accounts already. They're a tax sensitive client base, and not all of our clients fit that profile. And there is still a strong demand from our client base to have choice. Some advisors prefer to use mutual funds. Some prefer ETFs or separately managed accounts. Here at Dimensional, we want to offer that systematic value-added approach in whatever structure the clients prefer. So we do intend to expand our lineup. That may not be through future conversions if those aren't the right fit, but we're going to continue to evaluate what we should bring forward, again, to meet that strong client demand. There's one thing I wanted to mention. So in addition to the 2 that are converting later this year, we did file for 4 fixed income funds, ETFs, and we're in the quiet period on those, but we're very excited, obviously, about expanding our lineup.
Very interesting, definitely. So what do you think, what is the impact of these conversions on the mutual fund industry?
You can't deny the demand for the ETF wrapper. I think every asset manager right now is having that conversation of, what Dimensional's already done. Like we've already innovated in this space in terms of converting mutual funds into ETFs in really very large size. And I think it behooves the industry to ask, what's in the best interest of the clients? Maybe not every mutual fund is the right candidate. There's a sweet spot of investor type. Maybe some retirement account type clients would prefer, mutual fund wrapper, and maybe other types of clients prefer the ETF. I think that's a question everyone is asking. I've definitely been hearing it from my network quite a lot. We're going to be very cautious again and go very slow and methodical in our approach, like we do everything else. And you just heard Wes talk about our investment approach. It's the same when we think about product development. We want to make sure that we're bringing out the right products to meet that investor demand. And I expect every asset manager will look to what Dimensional did and start to do similar analysis.
Excellent. Good luck with all the upcoming conversions. And that's all we have time for today. Wes and Nicole, thanks again for joining us.
Yeah, thanks so much for having us.
Yeah, thank you.
That was our conversation with Dimensional Fund Advisors. I hope you enjoyed the conversation. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcasts. And also make sure to subscribe to the podcast so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.